Hello and welcome to Pro Trader Strategies Market Commentary for Friday, March the 2nd. My name's Eric Wilkinson. Some of you may recognize me as the Wolfman from CNBC, Fox Business, or even the Wall Street Journal for my commentary on everything from economic to geopolitical and market analysis. Please keep in mind that everything that we talk about in these market commentaries is not a solicitation to buy or sell any of these securities or strategies. At the end of the day, we're here to teach you some different strategies that you can implement into your portfolios, but please do that in your own way. The reason why I can't give you a recommendation on a particular stock or strategy is because I don't know your risk parameters. I don't know what's in your portfolios, and therefore what I'm doing could be counterintuitive to what you are already doing. And please remember that past performance of any trading system or methodology is not necessarily indicative of future results. All right, having all that out of the way, let's get it on with economic data. It's Friday, March 2nd, first Friday of the month. Well, we aren't getting unemployment this month. And the reason why is because a lot of times if there's holidays or a shorter month like a February where it's a very short month and that Friday comes up very quickly, they don't have enough time to compile all the information. So they bump it out to the second one. And it happens a lot on short months like February, and when it lines up very closely, whether it's the first is a Friday or the second is a Friday, they'll bump it out to the next one. That's what we're seeing here today. So no unenjoyment Friday for you guys all. So we're going to have to wait till next week for something like that. The other thing we got going on right now is across the pond, we got German retail sales month over month came in at a negative 0.7%, expected to be a positive 0.8%, so not good there. They did revise last month's retail sales number up from a negative 1.9% to a negative 1.1%, so better than expected there, but again, not really making up for the deficit we saw this month, being, basically, what is that, 15 hundredths off. Then on to the German import prices came in a little bit higher, 0.5%, expected to be 0.4%. Great Britain construction PMI came in at 51, expected to be 50.5. So better than expected there. Anything above 50 being expansion in the economy. We're still seeing that across the pond, at least in Great Britain. And then we got the European PPI, which isn't their flash PPI, so keep that in mind. Came in line with expectations. And then let's roll it back over here to the United States. We got University of Michigan Consumer Sentiment, 99.7, expected to be 99.4, so higher than expected there. And we got the inflation expectations at 2.7%. One thing I forgot to mention yesterday was we had total vehicle sales, basically all of the companies coming out with their vehicle sales, and they came in line with expectations at 17.1 million units. Now, that being said, one of the things that I noticed was Ford GM, basically 7%, their sales were 7% less than last year, so same time last year. So we're seeing U.S. automakers kind of flutter here with sales, and what I'm trying to get around to is these tariffs. Tariffs aren't going to help anyone. Free markets are the best way to do it. I'm a Milton Friedman fan. And I've been backing Trump, but, in some of the things. I like the Republican idea rather than the socialist idea. So, but this tariff thing is not in line with free markets and things of that nature, which I am a huge proponent of. So tariffs aren't really going to help the automobiles because they're talking about raising these steel tariffs. And then it's just going to basically cause a trade where everybody's going to start doing tariffs again and stuff like that. So I think we should stay away from tariffs. It brings the overall global economy up. That will bring us up as well. Anyway, that's my little soapbox. But total vehicle sales, probably not going to help U.S. automakers if they have tariffs to deal with. All right, on to the overall markets. We got crude oil moving higher a little bit today. We got a couple of counter-opposing dojis. I was expecting this to kind of, late in the day yesterday, we would see a little bit of confirmation to the upside if we got some good economic data, which we're still getting some pretty decent economic data across the board. But, having said all of that, we're just not seeing the gasoline prices go down, or inventories go down is what I should say. Gasoline prices, that's what I was thinking in my head, is these gasoline prices keep going up because it's related to the price of crude oil. And I just have this conspiracy theory that these guys are trying to do the Shell game where they are putting these crude oil inventories into gasoline, and they're at historical highs. I don't even know how much capacity there is left in these, but nobody's taking notice of that, and gasoline prices are going up, which is probably exactly what these guys want. All right, on to gold futures, up about $14 on the day. Just can't stay above this 78 Fibonacci level. We talked about this with the 50-day, the 9-day, the 78 Fibonacci level, all coming right here and touching, and that is going to be a major line of resistance. As you can see, it tested through it. The 50-day went up to the 9-day and just came up shy, and now we're back down below that. Just not a whole lot of momentum here. It looks like it's kind of shaken out and continuing pattern to the downside as of right now, if nothing else changes. Bitcoin futures down a little bit today, a couple $100. They've been really stuck in a pretty tight range between 1,100 and 10,000. Doesn't want to break out much more than that, whereas in the beginning we were seeing, 1,000-point moves in Bitcoin around the horn almost every single day. Today we're starting to see it start to calm, or last couple of weeks we're starting to see it calm down a little bit. All right, bonds off a point today, basically bearish engulfing pattern after yesterday breaking above that 9-day moving average. I thought that we were going to, or simple moving average, I thought we were going to stay above that. Today, a lot of downward pressure. Bonds are down a point. Equities are down pretty big as well. It's a little bit of a conundrum as to why the bonds are down. There probably is some Fed governor out there talking about cranking up rates as fast as they can. All right, VIX moved higher today when the Dow really spiked lower off the open. We got a bit of a rally and then started selling off again. I'm surprised VIX hasn't started moving a little bit higher with the equities coming off a little bit more. As you can see with the Dow Jones Industrial Average off about 200 points, we've had a pretty big rally in the last probably 20, 30 minutes. With the regards to this, I thought that we were going to be down closer to 250 or something like that when I was getting ready to do my talk. But the equities are starting to make this little bit of a doji down here at the bottom of this move. So, we can see that we could really start to see, higher lows and higher highs. So that's what we're going to have to kind of watch out for here. No confirmation, but to me, this is looking like it might be a little bit of tired of selling off with the Dow Jones and regards to the NASDAQ. This morning, NASDAQ, when I came in, we started opening up, really blasted below here. I couldn't believe it was down that much. Now we've kind of rallied back up into the trend channel. Again, this doji making it look very supportive. We're going to have to wait to see what happens at the end of the day, because the last couple of hours or the last hour of the day for the last couple of sessions, we've really seen some very bearish selling going on. A lot of volume coming in at the late end of the day. A lot of this has to do with these tariffs and people talking about these tariffs. It's really causing the overall market to come off because, the market knows tariffs are not probably going to be that great for the overall economy. All right, E-mini S&P is another similar situation, very close to clawing its way back to unchanged after testing the 38 Fibonacci level here this morning, which coincides right with that value area high for the most part. We talked about that was going to be a pretty tough nut to crack. We broke down below there, just pierced it for a second, and like I said, we started getting this rally back here quite recently, and it's really starting, these equities really starting to make like a foundation here where there's a lot of support right around in E-mini S&P's this 38 Fibonacci level. Let's look at the daily charts. This is what I was talking about. I'm getting ready to do the daily market commentary. We're near the lows of the day, and basically in 30 minutes or so we get a massive rally up, and that's a nice move right now. So overnight inventory getting kind of short. As you can see, coming in here, it looks like we're pushing them out. We'll have to see if that's another situation where these late day sell-offs start happening, where they kind of squeeze out the overnights, get them out of their position, the weak hands, and then slam it down at the end of the day. Same situation where we were getting short overnight, and then coming into the day session, we open up right here, and boom, off to the races, flush out those weak hands. Late day sell-off is what we are concerned about, though, because that's what really kind of sets us up for Monday. All right, the only thing that I've done here is in Honeywell International. ticker symbol HON, both in my margin and in my IRA. Let's talk about my margin account right now. Went into the March. There's only like 15 days left. I don't want to really go out that next month because there's just a lot of directional issues going on right now in my head. Where are we going to go? We have this high implied volatility. So I'm kind of moving closer to the expiration. You know, I don't usually like to trade inside of that 15 days to expiration, but I also don't want to get stuck in a 50 days to expiration with all of this market with the market trying to discern what direction it wants to go. I don't want to start putting a lot of money on the table before I start doing that. I mean, I have a lot of money allocated right now, but it's mostly short calls. I added short calls today with Honeywell and went into the March, like I said, expiring on the 16th. Sold the 155 calls in there for 38 cents in my margin account. Over in my IRA, defining that risk by after selling those March 155 calls, I bought the 162 and a half calls to define that risk, and I sold those for 32 cents on that spread. So basically paying a nickel to get out of it. I got my margin account a penny better than I did in my IRA on the selling of those 155 calls. But having said that, Honeywell looking a little bit bearish. They might get a little bit of a bounce, but as you can see with those 155 calls, I am way up here, just above where the point of control is. So in the next 15 days, if we manage to rally up to that point, I'm still going to be out of the money. I don't really see it coming up and testing these highs or anything else. It might get a little bit of a bounce towards that, but we could even see it just kind of bounce sideways here and build up this volume node as we've seen it do in the past. All right, so that's what I'm looking for, a little bit of bearishness, not a massive rally in Honeywell, but maybe it'll get stuck at the point of control. If it does try to rally, that would still keep me safe. So as long as we can stay below that point of control for the next couple of days, maybe next Friday I'll be able to get out of these if we can kind of stay below that. All right, that's it. That's all I got. Today's webinar is going to be on the long put butterfly. We did the long call butterfly. That has its time in the limelight, I guess, if you will, depending on the environment, the situation that we're in. But the long put butterfly, generally the better option because puts usually get pumped up with premium a little bit more than the calls. So a lot of times the put butterfly is a better alternative or a better choice between the two because you're basically looking at the same market assumption moving sideways, both the call and the put butterfly. Sometimes the call is better, sometimes the call butterfly is better, sometimes the put butterfly is better. I'm going to show you how to discern when and where to implement these type of strategies in today's webinar. You're going to be able to know how to build it online. That's easy. Anybody can tell you how to do that, but not everybody's going to teach you how and when and where and what strikes you need to do to implement a butterfly, a long butterfly, and increase your probabilities of profit. All right, that's all I got for you guys today. If you can't take that, take it easy.